Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Thursday, June 22nd, 2023. What I'll do in this one, as usual, a quick update on the equity markets, look at the indexes, key levels to watch, developments, what happened today, what should or most likely will happen going forward. That's what it's all about. We'll look at some of the recently highlighted trade ideas. That's the semis, ag, commodities, and wheat and natural gas. As far as energy and euro, gold, silver, and all that stuff. Briefly, just hit on everything. And then I do want to cover a few things that are in my things to watch list. That's a watch list I created a month or two ago. I shared it with you before. It's just various stocks, sectors, commodities, things that I think are relevant at this point in time where we're at with the economic cycle and the markets, things to watch there. Okay, so we'll get to those in a minute. So let's just start out with the equity markets, knock that off quick. So today we were headed early on. We were down red early in the morning and headed for the fourth consecutive red close in the Qs. Now we had a stick save. It rallied up. I'll get to that in 1 second. But we haven't seen four consecutive down days since May. And before that, gosh, you got to go back, see four red candles. Oh, goodness. We're going all the way back here, unless I missed some, just kind of scanning here, all the way in December, right before that last late drop, late 2022 drop. Either way, but it wasn't that. It was a stick saver reversal, but nothing technically changed. I'm going to show you that on the 60-minute chart. Don't ever mistake any big up or down day for anything more than just a random move, unless it's a breakout. You get a breakout candle on high volume or large gain. That's a breakout above support or resistance, break down below trend lines. Then it's significant. That's certainly technically significant. Today wasn't. I'll get to that in 1 second. And more so, I want to look at what drove today. Reminded me a lot of where we were at just a couple months ago when we were having those bank failures. We had three of the biggest bank failures in U.S. history, all in short order. And one of the oddest things that I've ever seen the markets happen. Big tech stocks were treated as flight to safety instruments. Almost everything else was going down. Market breadth was abysmal. Most stocks falling, and people were running into Apple and Microsoft and Amazon and the likes, like as if they were flight to safety bids. We saw that today, but I always say one day doesn't make a trend. But I did want to point out, despite the impressive turnaround and 1.18% gain on the NASDAQ 100, QQQ, which we're looking at here, the equal weighted was barely up. It was only up 0.29%. So it just shows that, and I can, I looked at the, you can see them on there, the Apple, I'll show you, 1.7%, Microsoft 1.8. Most of the net gains in the NASDAQ 100, especially the Qs, the overweighted Qs, or regular NASDAQ 100, was Amazon 4.3%. Tesla 2. Only one down was NVIDIA flat. And that's a theme too. The semis continue to lag. I'll get to that in 1 second. So again, just wanted to point out that internals were not, in one day doesn't make a trend, but they were not good today. You had just a few handful of stocks. And it's also evidenced by the S&P 500, which had the same thing. We're also looking to see the first 4-day losing streak in same time period since April right there, or late April, early May. And before that, you have to go all the way back, probably like the NASDAQ. Yep, you do, to December. Now, again, it wasn't that. We had a stick save. We printed a green candle, but barely. We're up 0.36%. And then when you look at RSP, which is the equal weighted, we do have now 4 days. So again, this showing you, even in the broader S&P 500, a much more diversified index, we've had the first 4 consecutive red closes now since right here you had 4 red, and they were kind of in a sideways range. This is a much deeper drop off. Again, just pointing that out that today, the internals certainly weren't confirming the rally, if you want to look at it that way. And then when we go to the 15-minute charts and 60-minute charts, this is where this is still an active trade. Still targeting the minimum for the final target, near-term target for this short-term swing trade. I'm referring to the typical swing trades, that uptrend line. And so far we had the sell signal here, check on the breakdown of the bearish rising wedge. right there, and I'm trying to circle it. And all we have is a run-of-the-mill downtrend. A downtrend is defined as a security making a series of higher highs and lower lows. So now if we start to take out this level, and that jives with what I gave you today on the 15-minute chart when I gave you the update, that starts to change things from a technical perspective. And I'll explain myself in just a second here on the 15-minute chart. So that's it. So there's QQQ. After the fourth day early on today of being down, dip buyers came in, no big surprise. Plus, it was technically induced with the drop to support and divergence that I showed you yesterday. Mentioned that, active traders might want to go long game of bounce. SPY, again, flat and still well below the uptrend line on the 60-minute chart that broke the other day. And remember, we had support here. I had this support marked at 434.81, and you can see that was the top of this gap, or close enough to the top. And what SPY did today, there's the bottom of the gap right there, and so that's basically made a gap backfill. The buyers stepped in, which they often do on an initial backfill of a gap. But again, a very muted bounce, and really not even below that previous high there. Step down to the 15s. You can see on SPY, the S&P 500, I put up Fibonacci retracements. That's measured, it's this purple line right here, measures from the high down to the low. That line. Okay, it was right on there. And you can see we haven't even, I think you can see, this is a typical counter trend rally in a downtrend will retrace anywhere from 38.2 up to the 61.8% Fibonacci retracement with the 50 in the middle. And so you can see that's the 38 fib right there, 38.2. We haven't even retraced that. So even now, this isn't even a typical retracement. It's just almost just some sideways consolidation for the most part. QQQ, thanks to the FANGs today, but they ran right up to, you can see, if you can't, I'm going to read it out. Here's your fibs right here, 38.2, 50, 61.8. The lines are right here. Again, I have a black chart with purple lines, so I'm just going to bring it over. There's the 50% fib, right? That's what we ran up to today and closed right maybe a hair below it. So again, just a run-of-the-mill counter trend bounce based on Fibonacci's. And again, when you turn off all the lines, these are your reaction highs right here so far. So, and that's why if, we go up much higher, if you recall this morning, I get this update out to you. If you recall yesterday, we were right off this 360, 50-ish support. And I gave you a bounce target, favorite to bounce. Said it would go anywhere up at least to that level minimum. And the max bounce target zone I circled was, I think, right around here. So that's why this morning I said, if we continue past the trend line, any bounce up to, but not above that 367.50-ish, I will still view, so if that carries over tomorrow, still view that as an objective shorting level. And to me, that's where things start to technically change, because that 367.54, although you might not be able to make it out, I wish I could make these bigger, that's the 61.8 Fibonacci retracement level just above it. So if we take that out, take out 368 by a fair margin, we're going to have taken out this previous reaction high. We're going to take out the 61.8 fib. And so then it starts to make it harder to say, well, you can't really at that point say we're in a confirmed near-term downtrend. You could say, maybe put in another high that falls short of that high, and then you go make a low, and then those are your reactions, right here and here. But as of now, again, very near term, this is our near term downtrend. So again, don't want to make too much of it. Just want to point out that that's where we're at. So we took out the downtrend line, back tested it, but then we ran right into resistance, same resistance levels I've had on this chart for last several days at least. So that's it on the equity markets. Again, green days, but at least on non-equal weighted indexes, non-equal weighted QQQ, and SOX semiconductor ETF. Nothing really changed there either. In fact, the bounce has been very muted. The only thing that changed, I noticed today when I was going over the charts, I somehow brain farted the other day. I was talking about on Tuesday right here. I told you guys we had, when we closed right here. We'd taken out S2 and closed right on it. And I said you had this potential bear flag. And I said to take the measured target, what you do, you take the flagpole, which is the impulsive move leading down into the formation of the flag, and then you add the line. Now, what I did with my brain farted, I've been doing this forever, and I don't, the measured target is supposed to add to the top, and I had that line stuck there, which is kind of quirky, and it came out there, and it was under that level. I just wanted to point that out. It really doesn't matter. I'm still, we're not even to my first target yet. This is just S3 really, this zone here. I put a little support zone, which is, you can see right here, we have a gap. And just like SPY backfilled that gap, this is the bottom of the gap right here where I put this lower line. It's right at about 487. And so that was a gap backfill, just like SPY. That's where the buyer stepped in on the backfill of that gap, but very, very muted. And so the semis are continuing to show weakness. Again, relative to the Qs and the NASDAQ 100, which was up over 1%, they were only up 0.47. And again, so far a very muted bounce or reaction, if you will, on that support level. So we need to take that out. Just because we hit the measured target doesn't mean the whole move is over. It's just that's what that was. I just want to correct that. So that's it. Still maintain this. And really, I'm still T1 is not a hard level. As far as that, it's just if you want to take some quick profits, if you didn't already. I mean, this trade was already up about 5%, but I still like it down to the uptrend line. And right here on the 60-minute chart, and that's going to be about another 10% drop from where we're at. And then so while nothing changed today on the 60-minute short-term intraday charts with this very near-term downtrend, again, the intermediate term trend is certainly bullish, just the very near-term trend is bearish at this point in time. And then I mentioned, and I didn't prep the long-term charts for this video, but I have been covering, and I did earlier this month, a lot of my long-term, my most reliable long-term trend indicators are still bearish, have been since the bear market shortly after it started, haven't flipped to bullish yet, but are currently, or were early in the month, poised to, unless we drop. So I went over that before. I think it was the S&P had to drop just 4-5 percentage points. Where I'm going, if this plays out and there's only a little over a week left in the month and we come down here, that means QQQ is going to fall in line with SOX. Not in line, but it'll fall as well. You're not going to see SOX drop 10% without the Qs going down at least 3, 4, 5, right? So what that's going to do, it has the potential to keep those long-term trend indicators like the 20-month moving averages and some of the histograms, keeping those sell signals on bearish or intact, the sell signals or the trend indicators, keeping them bearish again. But we need to see some downside in the next week or so going into the end of this month. Otherwise, they have the potential to start flipping over. So that's what I've been saying it's been months. We're pushing the upper limits of what you can make a decent case from a technical perspective, or at least I can on my indicators, my charts, that at this point it's still a bear market rally. But that starts to change if all of a sudden they start buying this up, blast off, and they take the NASDAQ 100 and the S&P 500, they take them up above, especially another 5% plus above the recent highs, then that starts to change the longer term, a lot of the longer term trend indicators. But we do this and close a month down anywhere around here, then that's going to keep those trend indicators on sell signals and indicate that not only still will support the case this was a bear market rally, but because we hit those upper limits, will increase the odds that that was the end of the bear market rally. So we'll see. A lot to do there in a week. So let's not get too far ahead of ourselves. If you're in this one now, you just decide if you're, you are profitable if you took it on the sell signal. You want your stop here. Do you want it very tight above there if you didn't take profits already? At the very least, if you're swinging for the fences, stop at break even would assure a zero loss, no losses on the trade. That's something to consider now. if you haven't done so, lowering stops. Okay, so covered that. Before I move on, a brief update on the commodities, at least the ones that have been trade ideas lately, like wheat and natural gas. Let me just cover those items that are on my things to watch list that I think are relevant because they're related to the equity markets. And the first is KRE, the Regional Banking Sector ETF. Okay, so back here mentioned, look, all things that look, we had that strong positive divergence, played out for a pretty decent bounce so far. But as you'll notice, today was the first. I haven't really updated KRE lately. I have no horse in this race. I don't care to. It's not my kind of chart. But I'm going to draw a little uptrend line off the lows, and you can see pretty clean. 1, 2, 3, 4 candles, 5 as of Monday. Is that Monday? Yeah, Tuesday's candle. And more importantly, is this 41.39. You can see here it was support. We bounced, hit it again, bounced. Hit it again, bounced, tried to break it out, but then closed right back on it there, bounced. And when we gave it up, we didn't just limp on down. There was a big red solid, a lot of selling. Stops were hit, a lot of shorts piled in, whatever happened. And it doesn't, it only lasted, it was a short drop, but it was a drop from that point, 16.5%. And then we rallied all the way back up there, rejected. We rallied up, finally took it out on a big green candle, tested it the next day, and then moved away from it on an even bigger, more impulsive candle. So that to me says that's a pretty significant near-term level. Again, I'm watching it. This is in my things to watch. So it's not my active trades or any positions I have. There's too much. The RR is not clear to me. The risk reward is not skewed. I like trades with favorable. This thing could pop either way. There's so much government manipulation trying to stem up the banking system, but yet they have a lot of problems. So I just wanted to point that out. Now, what does it mean? Well, number one, watch it. If we recover that level and we get back above this trend line, great. That shows okay. If we start to build on these gains and we start to take out these previous reaction lows, then each and every one is incrementally more bearish, and it says, something rotten in the state of Denmark, or at least in the state of regional banks. So just watch it. That's what I'm watching for right now. The other things on my watch list are ADP, biggest payroll processor. This is kind of a tell. We had another tick up, unemployment claims, not by much, but exceeded expectations again. So we've seen a trend. I think I have some charts for you here. So as always, if you go to resources on the top end of your site up here, you click that, it's going to bring you into the support center. I use this almost on a daily basis. Tools of the trade, click on economic calendar, and it's going to bring you to the economic calendar. And today we had jobless claims. You click on that, it'll give you the details. You can zoom in. So nothing big, but we had another tick up. Prior claims were 262,000. The consensus for this week was 261. We came in hotter at 264, so above consensus. And again, it's all about trends, not any single number. And that trend can be seen clearly here. This is trading economics. We're looking at the jobless claims ticking up. I've seen, there's an analyst at Piper Jeffries. He has a model that they've come up with called the HOPE model, and it basically tells you, economic cycles, stock markets and the economy bottoms when the housing market bottoms. That's the first turn, housing. And so the whole stage is as HOPE. The H is for housing. O, I believe, is orders, new orders. Obviously, when housing starts picking up and confidence is rising, orders start picking up, and then profits. First you get orders. Companies receive orders. Then it takes a while to sell those goods, and they make profits. So that's the P. So, but the point was, on this model, they've all turned down. Housing has already peaked down, and they use the home builder sentiment survey as one of the most accurate gauges. Orders, new orders have already turned down. Profits have turned down. And the last straw, the E, is employment. And that is obviously now we're seeing signs of the job market is finally softening. So, and that's typically where we are in the cycle. So I'm watching. The point to that is I'm watching those companies that will help provide and give us a tell. Today was the same of what we've seen. big fangs. Everyone wants to buy those big market leaders. At least today, they've been under pressure lately. Don't get me wrong; they're a lot of them are down, but they still need to break their primary trend lines. But when I look at ADP, this was the uptrend line off the COVID lows right there. It had a divergent high. Then this minor trend line, kind of like what we're shorting, what we're gaming or I'm gaming. Hopefully, I don't know, some of you are or aren't, I don't care, on the Qs and semis. So you had the minor trend line break, and then I'm targeting the larger trend line. But like I said, once the larger trend line breaks, that's a more significant sell signal, and that has broken. Now, I'll recognize there was some divergence here that may or may not play out. But most importantly, we're below trend. We're below the 200-day moving averages, and you have this little trading range right here on ADP. I'm trying to use my box tool. Software's fighting me. There we go. So that was really proved to be a whipsaw so far, but we're back to the top of the range. And then when I look at the weekly chart on ADP, this is what I see. This is big picture. I like to really look at weekly charts. It's my opinion that a lot of traders get caught up in the very short-term charts and don't see the forest through the trees. But that's the primary since the 2008 lows. The stock market itself bottomed in March of 09, but tech, only in the NASDAQ, that is really in tech, bottomed in late 08, as did some other companies. And so this is a secular or large bull market with, cyclical or corrections. I call them corrections. I just call this one big bull market. Even COVID to me was just a correction, even though it was well over a 30% drop like that one. But it's a very well-defined trend line, and I've said it many times. I named the COVID correction, I call it, Ursa Interruptus. There was a lot of evidence that a bear market was priced in, and it started. COVID was the catalyst, but... Okay, so the Fed and Washington, D.C. both came in with, the nuclear option, monetary and fiscal stimulus, and kind of, averted what would have almost certainly been a larger bear market. So it's my, made-up term, Ursa Interruptus. Anyway, but that trend line was valid, and we had so many reactions. That's a 10 on a 1 to 10, all those reactions to break. And then even when we recovered it, we've been respecting ADP, and it finally broke down this time organically, if you will. Or at least there's, no, massive stimulus coming at this point in time. I think we're all agreeing on that. We've gone the other way. We're in a contractionary monetary policy instead of a stimulative one. So there's the uptrend off the COVID lows. That's broken to that wedge. And again, we're below the primary trend line. So one to watch, because this is, again, if you want to, people used to, back in the old days, watch copper as a leading indicator for the economy. It was nicknamed Dr. Copper because it had these, predictive abilities. But then China came online, was sucking away such demand with their huge growth that it kind of obscured the supply demand dynamics for the United States. So it wasn't as kind of got stripped of its title or its PhD, if you will, on predicting economic downturns in the U.S. But so I just watch these things that will tell you. Of course, obviously, as I just said, and nobody's going to argue that. I don't care who you talk to anyone who knows economics. They will tell you the single most important thing are jobs and consumer confidence and how the consumer is doing, because consumer spending accounts for over 2/3 of almost 70% of gross domestic product. When the consumer breaks, the government can print, spend all they want. They cannot offset a consumer that's out of work and out of money and tightening their belt. So watch that one. And when I say watch it, what does that mean? Well, if it breaks above 283 and it breaks above the 200 days and it starts to rally, then that's saying, hey, guess what? Things are probably good in job market world. Their profits are going up, probably because there's more and more people using their services, their payroll services. Goes down, you can see my support levels, if and as each one's broken, first there. So again, just something to watch. I don't want to spend too much time on it, but these are the things that are on my radar. I don't talk about them every day, but when I start to see, things that are, worth noting. Some of the other ones I think are proxies for the, or good proxies for the economy, are the big shippers, UPS and FedEx. And so, you can see on my UPS chart, UPS peaked all the way back here. And UPS, unlike Apple, Nvidia, Alphabet, and a few, AI hyped, stocks, are, solidly entrenched in a bear market. That was the bull market highs. based on the scope of the drop and the fact, again, a downtrend is lower highs and so lower lows. So far, that was the previous major reaction high. Now, it can go either way. We need to, obviously, there's or this is the most recent major reaction high. So we take that out, and that starts to chip away at the bearish case. Take that one out, certainly more so. And then you have the early makings of an uptrend off this low. But so I'm watching this one, and so if it does this, then you have a continuation of a downtrend, and a lot of the stocks that are really more representative of the economy and not just wrapped up in the AI tech bubble right now are kind of pointing in the same direction. So I just want to let you know where my analysis comes, especially lately. I mean, gosh, there's just some people that are outright, just almost angry that I'm still viewing this as a quite likely a bear market rally, and we'll see. Like I said, time will tell, and there's a lot of other trade ideas. If you're not making money in wheat right now, or natural gas, or even the semi shorts, and there's a lot of things out there that you don't have to trade the stock market, or you don't have to take trades that I see as bullish or bearish if you don't agree with them. Oh, and there's a big level. Let me just. Oh no, I already had it there. 154.90. Big level. Big shelf of support, even going back here to 2020 and 2021, and then that was the recent low there. Oh, so all right, let's move on. Just watch it. Nothing that's going to happen today or tomorrow, but going forward, keep an eye on that one. And then FedEx been a little bit stronger, but still, again, turn off all the lines and just look at the big picture. Boom. Got your lower highs and lower lows. Quite the rally. That's what bear market rallies are. They're very impressive. I love to trade them. They're powerful. They're convincing to those that have never traded a bear market. They seem like a new bull market, but sometimes what I think is a bear market rally goes on to be a part of a new bull market. We'll see. But what I see here, you can see my lines. I've got a nice negative divergence. There's our divergence line. Trend line 1, the minor trend line from there. Here, I'll zoom in a little for you. And then trend line 2. So negative divergence, clear negative divergence. And so if it can reverse here, it was up pretty healthy today, even though UPS was down. But watch this. This is sell signal 1 on the break of this trend line, and sell signal 2 on the break of that trend line. And, just kind of bigger picture, you can see, same downtrend if you turn off all the lines that I showed you there. So those are the levels to watch and stocks to watch, because they are, economic bellwethers. When the economy's booming, and a lot more packages being shipped. It's not rocket science. So we'll watch those guys. What other ones do I have for you? Those are it in my watch list. Then the other stuff, again, don't get any comments on anything lately but the equity markets. But wheat still up today, but again, you're still pushing against that T2, and it's getting near-term overbought. On one hand, I said when wheat wants to run, sometimes it keeps going. So you have to have a trading plan. I do maintain these additional targets. It's just a matter, are we going to have a pullback first? Probably, and then another leg up. Maybe not. I'm not seeing broad-based. There's still a lot of commodities I'm avoiding right now. No, when those start to look good, we'll jump into those. Right now, it's the grains. That's where my focus has been: wheat, corn, soybeans, and then of course energy, namely UNG, has the best looking chart. We had that 60-minute divergent low on oil lately, but this is big daily positive divergence, and we're still at that T1 level. And so far, I always say each price target. The reason I list multiple price targets is each target is likely to produce a reaction upon the initial tag. And my definition, again, of a reaction is one of two things. If you're going up, a reaction means a reversal, or you stop going up and you consolidate. Or, so this one so far, this is the more bullish of the two. When you mostly go sideways. And again, we had some 60-minute divergence to give it that little pullback, but pretty strong. So now if it can pop that, it's been consolidating, boom, should run up T2, T3, and so forth. Okay, and last but not least, I've gone over lately the correlations between gold, silver, euro, the US dollar, and the stock market. So euro is still right around that support level on the daily I've been highlighting. And this is what it looks like to get a kind of a more near-term picture. This is a 60-minute chart. E7, these are Euro futures. You've got this divergence steepening. You've been building divergence. Now you even have it down here on the PPO, and you have a very well-defined trend line right there, and that some price support. So boom, if we get this, we're going to see another leg down in the euro, which I still favor. And the pattern, at least for the last year and a half, almost 2 years, has been a positive correlation between the euro and the stock market, the major stock indexes. So that would mean euro down, market down, and then gold and silver as well. That has been over many years an on-off correlation. It's a little more solid with gold and silver. But as I like to say, support is support until unless broken. So you want to see that. If you want to increase the odds, wait to see that break of the uptrend line. That's, again, 60-minute chart. You can also look at the dollar futures, or the dollar index is DX. And remember, that moves inversely to the euro. So you have an inverse correlation between the stock market and silver. This is a bullish falling wedge pattern, complete with your positive divergences on the hourly time frame. So if you get a breakout here, the measured target's the widest part of the wedge added to where that breaks out. Unlike the bear flag, you add that to the bottom, or bull flag, but on a wedge, you add it to where it breaks out. And so that would be a nice pop in the dollar, which also, again, would, based on recent correlations, mean equities down and most likely put pressure on gold and silver. All right, I'm going to wrap it up here. Keep this one relatively short, get it out to you, and we will pick it up again tomorrow. This has been Randy Finney with Right Side of the Chart. Have a great day.